Hello friends, welcome to my YouTube channel at One Raj Kamal. As you go through this video, please subscribe and also press the bell icon so that you can get regular updates on new videos being posted here. Last week was a pretty weird one for the markets. Most participants would have thought that this was a pretty down week. However, surprise, surprise, it was actually an up week for all the three indices, with Dow Jones up nearly 2%, S&P 500 up nearly 1.5%, and Nasdaq up 0.7%, as you can see on this chart. However, the story was a pretty mixed one. The first 3 days saw the markets rally. Then there was a small decline on Thursday and a big decline on Friday. And that's the story of two parts. On Friday, in fact, Dow Jones dropped 630 points or 2.1%, as you can see on this chart. S&P 500 dropped 2.8% and Nasdaq, the highest, dropping nearly 3.8%. The story was mixed across sectors. See this chart. You can actually see energy up 13.5% for the week as OPEC announced a cut in production. But many other sectors rallied as well and were positive. Communications, financials, healthcare, industrials, materials and technology were all in the green. Only the rate-sensitive sectors such as utilities and real estate were actually down for the week. The big driver for the week was the jobs report that came out on Friday. The first Friday of every month in the US has the jobs report coming out, and that's always market moving. See this picture where the jobs report shows that non-farm payrolls, non-farm private payrolls, both were up higher than expected. The unemployment rate came down at 3.5%, lower than 3.7% in August. And that was pretty notable as well. What is this jobs report and what are we talking about over here? Well, non-farm payrolls shows the change in the number of people employed in the previous month, which happens to be September in this case. And this is excluding agriculture or the farming industry. What is much more important is non-farm private payrolls, which also excludes government workers, private households, proprietors, and non-profit employees. Effectively, the Bureau of Labor Standards indicates that about 80% of total US employment is covered in the non-farm private payrolls data. And it is pretty important because with this coverage indicates the measure of consumer spending, because if there are jobs, there'll be consumer spending. And we all know that consumer spending is the biggest driver of the US economy. Why did the markets react negatively to this news? Well, for a few reasons. The first is such a tight job market where unemployment rate is 3.5%, that's really low, indicates that there is a high risk of wage inflation, that there are a lot of jobs and fewer workers, and therefore workers may demand more wages. So this risk of high wage inflation is there on top of the already high inflation numbers, and wage inflation can also be very sticky and difficult to get down. Second, this came on top of higher number on core CPI and PCE price index in September. And that was already something that had rattled the markets in the previous 2 to 3 weeks. Clearly, this jobs report on top of a higher CPI number for September makes the market feel that the inflation worries are far from over. And it is unlikely that the Fed would stop on its aggressive rate hike journey. What happens if the rates hike? Well, if the rates keep hiking, two things will happen. First of all, treasuries become attractive and emerge as another option other than stocks. And one of the things that has guided stocks going up in the last decade or so is what is known as TINA, which is that there is no other alternative, or there is no alternative. Now, with treasury yields being so high and 2-year is above 4%, 10-year is near 4%, there is an alternative. Secondly, as the yields go up, the discount factor on future earnings increases, and that lowers the prices of stocks. So overall, if rate hikes continue, stocks are unlikely to be going up, and they will feel headwinds in their price momentum. Finally, markets don't like uncertainty. Whatever happens, the biggest contributor to market behavior is uncertainty or elimination of uncertainty. This back and forth on whether the peak inflation narrative is over or not over is making the markets very anxious. It makes investors jittery. Buyers just don't turn up. And if they're only sellers, you know what will happen. The prices will go down. The week ahead begins the earnings season, and we will see all the big banks, JP Morgan, Bank of America, Goldman Sachs, etc., beginning to come out with their earnings. Over the next 3 to 4 weeks, nearly 80% of S&P 500 constituents will come out with their earnings report. Markets would be very keen to see on how these earnings pan out. If the earnings are based on what has already been priced into the stock prices, then markets could rally. If there are bigger surprises, markets could go down even further. Interestingly, in all of this, the Atlanta Fed's GDP now has actually soared in the last 1 week and now shows a number of Q3 GDP growth of 2.9%, as you can see on this chart. Effectively, in spite of a hawkish Fed, the economy is still not declining, and there may still be hope for a soft landing. Time alone will tell. Thank you.